Walmart. I want to bring in our next guest. He's David Abella. He's the portfolio manager at Rochdale, which has $4 billion in assets under management. Walmart, by the way, is a top 10 holding in one of their funds. David, great to have you with us.
Great to be here.
Scarlett outlined very well the problems at Walmart, and really the problem is how do they turn around the domestic business, right?
Well, that's right. I mean, it's going to be really tough to turn it around because the main reason for the weak same-store sales is the fact that they're basically saturated in the U.S. So whenever they open a new unit, that takes some sales away from their other units. Plus, you have increased competition from Target, dollar stores, those types of formats. So they're in a tough spot to increase same-store sales. Even so, given the fact that we have inflation, especially food inflation, they should at least be growing their same-store sales at that rate. And the fact that they're negative means real sales are actually down, and that's the big concern.
So what are they doing wrong?
Well, you know, wrong is the fact that they got saturated, which was help their unit growth and to get them where they were. I think going forward, it's just tough, and they're a little bit stuck on the lower end of the demographic. I think actually when you have
that's their core is the lower end of the demographic.
And that's a good core to have. I mean, it's steady, but on the other hand, that's the weakest part of the recovery right now. I mean, you're going to see some sales at Saks that are going to be pretty good. Nordstrom was pretty good. You know, so the upper end is definitely recovered. The Walmart end is paycheck to paycheck. Wow, you know, high price of gasoline being a problem, food inflation. So when that improves, and you know, if you're optimistic that it'll improve over a couple of years, Walmart's same-store sales should improve.
So as an investor in Walmart, then, is your hope just that Walmart keeps pace with the macro environment? Then you know at least you've made good on your investment?
Yeah, in a way that's the thesis. I mean,
okay.
the price to earnings ratio is very low at Walmart, 12 to 13 times, and they did have profit growth increase. So given negative same-store sales, that's a lot of leverage in the operating costs. So if same-store sales can go positive, there's a lot of potential upside leverage on earnings growth. And then there's the whole international strategy, which has good growth but not profits yet, and someday it may have profits.
If you find, though, that after 8 quarters of, you know, we've seen negative comp sales at Walmart, if you find that they're not keeping pace with the macro environment, would you trade out Walmart for somebody else or for something else, another company?
Yeah, I think that would happen, especially if you're in the next stage of the economic growth. And retail sales are better, and you're starting to see it across the board, but not at Walmart. I think investors will be very frustrated, and they'll start to bail even more so on Walmart.
Bail Walmart and buy what?
Well, they may just go upscale a little bit. I mean, I've come on talking about barbell strategy where a little bit of Walmart and a little bit of a name like Nordstrom or Coach, and some of that might happen. And then Target, which has troubles of its own, and we'll find out tomorrow. It's been an even weaker stock over the last year, but there may be some move into that on valuation.
Okay. David, great to see you again.
Great to be
here.
here.
As always,
Thanks.
talking retail with David Abella.